Good morning, everyone, and welcome. My name is Navina, and I represent Capital Markets Malaysia. For those of you who may not be familiar with us, Capital Markets Malaysia is an affiliate of the Securities Commission with a mandate to profile and position and support development of Malaysia's capital market. A key priority for us is to build capacity across the financial sector and for Malaysian public listed companies in the area of sustainable finance and sustainable corporate practices. Today's webinar is brought to you by CMM's Center for Sustainable Corporations, or CSC, which provides capacity building on sustainable corporate practices for Malaysian enterprises. The CSC is supported by several knowledge partners, which include ERM, Global Compact Network Malaysia, WWF Malaysia, and the CDP. Today, we're delighted to be collaborating with subject matter experts from ERM once again to bring you this timely webinar on carbon pricing instruments and how they can support climate ambitions. I've had a look at the slides and there's plenty to get through in the next 2 hours. So please allow me to introduce SK, who is Managing Partner for ERM in Malaysia and Brunei, who will introduce the rest of his team and start the session. So SK, over to you.
Yeah. Thanks, Navina. Good morning, everyone, and many thanks for your time. Can we have the slide pack open, please? Yeah. Okay. Yep. Yeah. Today, we have 2 hours together to talk about these carbon pricing instruments to support net zero ambitions. And I'm very happy to be here this morning together with my colleagues from ERM. Let me quickly first introduce my colleagues. Next slide, please, Kevin. Yeah. So today we have quite a packed things to share with all of you, and this will be we actually split the session to 2. First, we talk about the carbon pricing on the global trends and landscape. This will be done by Yulia and Tirapon, 2 of my colleagues based in Bangkok. And then section 2, we bring it home to Malaysia context. And this will be shared by my colleague Chin and Kevin, based in KL. Next slide. The objective of the webinar this morning is to introduce companies in Malaysia to the existing global and domestic carbon pricing instrument. So we will share quite a fair bit of like the carbon pricing concept. And then we'll do a high-level overview of all the recent carbon pricing developments and opportunities go globally in ASEAN, and later on we also talk about Malaysia. And more importantly, we hope this webinar will provide a good understanding of the role of carbon pricing in supporting climate and net zero ambitions, especially for corporations in Malaysia. Next slide. This is an overview of the agenda. Yeah. First, we talk about the carbon, some key concept, carbon pricing development, some global trends, landscape, and then we talk about some of the development in ASEAN countries. We also will touch about internal carbon pricing, which is a very important topic too, on the carbon pricing tools. And then we will have a session about Q&A. And the session 1 will take about 75 minutes. Yeah. And then session 2, we will bring it home to Malaysia. And this will be for about 30 minutes, and then followed by an overall Q&A. Yeah. I'm mindful one of my colleagues, Chang Tirapon, will probably have to leave after session 1, after the Q&A. Yeah. So this is overall of the overview of the agenda for this morning. Next slide. And a few couples of housekeeping rules first. I'm sure like there'll be a lot of questions asked. And I see on the participant list, we already have about 170 people. So we actually encourage you to post a question on the message box. And we have a slot of like Q&A after session 1 and after session 2 as well. And throughout the session, we also run some polling questions to gain an idea of your understanding of the material presented. And we also encourage you to share your feedback after the workshop so we can continue to improve ourselves. And if you have any further question or you would like to reach out to ERM, Chin and Kevin's email is actually listed here. Please feel free to reach out to us. Thank you. Next slide. Now I just want to spend briefly a couple minutes to talk about ERM. Yeah, ERM is the world's largest pure play ESG and sustainability consulting practice. So we celebrated our 50 years last year. And even in Malaysia, we already present in Malaysia for over 25 years. And this map actually show all the over 160 offices ERM have globally. We have 7,000 professional staff spread out in over 50 countries and territories. ERM is owned by employees partner. We are a global partnership. Like for example, like Yulia and myself, we are partners in a company. We own a small stake in a company, and we are supported by KKR, which is a very large institutional investor, control over like $250 billion fund. We pride ourselves boots to boardroom approach. What it means is like majority of our employees are engineers, be it chemicals, process engineers, environmental engineers, environmentalists, biodiversity expert. And we do a lot of field work. Like as we speak now, quite a lot of my colleagues actually in different part of just in Malaysia and Brunei context. I have a few of my colleagues offshore currently in offshore Brunei, doing like water sampling, biodiversity assessment before Brunei Shell lay the new pipelines. We have colleagues doing like impact assessment in different locations in Peninsular Malaysia. A few of my colleagues currently running some process safety workshop for our client. So we actually drawn on a lot of our technical expertise and practical experience. So the ESG and sustainability consulting work we provide is looking at is from end to end, from the strategy to the implementation, and finally to what I call the MRV, monitoring, reporting, and verification. We provide a very comprehensive sustainability and ESG consulting work. Next slide. Yeah, this slide actually shows some sample of clients that we have globally. Yeah, we are very actively involved with a lot of the oil and gas client, and also other sector as well. Yeah, this is just some sample. We also very active in the banks, the institutions, the financial institution, helping banks and different financial institutions look at different acquisition, pricing, ESG audit, sustainability audit for the acquirer or even for the company who position themselves for acquisitions. And not forgetting, ERM is also very active in all the sustainability and climate change initiatives. We are very actively, like for example, last November in Glasgow for COP26, we were present in many of the subcommittee. And we also actively involved in a lot of initiatives on climate change. For example, in the TCFD, ERM is the sole consulting company who actually provide the technical supplement for TCFD. So just quite an example. Yeah. Now I think I want to pause here. If you want to know more about ERM, feel free to go to our website, erm.com, to get more information or reach out to us. Yeah. Now I'd like to actually very quickly go through a very quick poll to understand our participant. Kevin, may I have the next slide? Yeah. Yeah. This is a very simple request for all the participants. Please log into www.menti.com and put in the code. Yeah, this is a code 9787-2123. Yeah. I think you all get it, so we can go to the couple of simple poll question first. All right, Kevin, next slide. Can I go to the first poll questions? All right. Question number 1. Which professional sectors do you currently work in? Yeah. Now give a little bit of time because I saw we have 188 participants. So there's still yeah. Yeah. Yeah, well, a big part of the participants come from the financial services sectors. There are couples from energy industry, NGOs, academics. Yep. All right. Yep. Question 2, please, Kevin. Yeah, I encourage you all to continue to actually give a feedback so we have a better understanding of the audience for this morning. Is a company a local, regional, or global business? Regional. Okay. Okay. Yeah, regional and yeah, balance of global. And yeah, I see we have about half the audience actually doing the poll, but I appreciate you'll give your feedback so we have a better context of the participants. Yeah, all right. So let's go to last question, Kevin. Kevin, please move to the last question. Yeah. What is your own current role at your company? Okay. I see there's a couple of audits, risk management, sustainability, corporate sustainability, business development. So quite a diverse pool of like audience. Yeah, head of equity research, risk management. All right, okay. So at least we get a good feel about our participant. Yep. Thank you very much for participation. Now I'd like to hand over the floor to Yulia.
Thank you very much, SK. Good morning, everyone. Very nice to have you all today at our event. And the first session will be dedicated to a very interesting, though sometimes technical topic about carbon pricing. And once again, please use a Q&A box for any questions or clarifications that you may need along this session. We will pick them up either through the slides or towards the end at the Q&A stop point. Let's move on to the next slide. And first of all, when we talk about carbon pricing, different people think about quite different things. Some think about carbon tax, some think about offsetting, some maybe about emission trading. In fact, this is all linked to the concept of carbon pricing. But what's the most important about it? It's that it's a policy instrument, in fact, that really sets the price on emissions related to the use of fossil fuels, as well as other measures that lead to greenhouse gas emissions. It uses a very important principle that polluter pays, meaning that those who emit greenhouse gases would need to pay extra price, making low carbon efforts at decarbonization more commercially attractive through those mechanisms. And on the next slide, you will see that, in fact, carbon pricing can be a useful instrument equally for businesses, for governmental organizations, as well as for investors. And I understand that the majority of our participants come today from the financial sector, so definitely that could be helpful for you as well. For businesses who set internal carbon pricing, which we'll talk about today as well, that's a very important instrument to address potential climate risks associated with carbon policies, carbon pricing policies that could be put by the governments ahead of those policies becoming mandatory. This is also an opportunity to already see what could be transformational options for the business using carbon price as an instrument to really seize these benefits from the low carbon economy transition. For the governments, of course, carbon pricing is a very helpful tool to manage greenhouse gas emissions within the country or a specific sector, or at subnational level, for example, at the city level. And we'll see on the next slides that such schemes exist also not only for the countries, but also for subnational geographies. Lastly, for investors, carbon pricing is a very good tool to integrate into your risks projections to see how that could impact your future investments and really reassess your investment strategies and prioritize products, companies, or projects that are leaning towards low carbon future. Let's move on to the next slide. And a very important concept that we need to understand that carbon pricing in principle can come in two different forms. The first form is cap and trade, or as it's also often called, emission trading scheme. That's not new. In fact, it was introduced a long time ago, even before the climate change topic, for managing emissions of pollutants. And it was firstly introduced by the United States. And then the scheme proved to be quite efficient, again, for this polluter pays principle. And then it was introduced later on the Kyoto Protocol and now is widely used by a lot of different geographers. In principle, the idea is that there is a certain number of allowances for greenhouse gas emissions that are distributed amongst market players. So the cap is there, the cap is understood for greenhouse gas emissions, but the price is actually dictated by the market. So companies either invest into their own emission reduction measures, or if it's cheaper to buy offsets from elsewhere, they can do it buying those emission reductions from other market players. And this is where the offsetting principle comes into the picture. So offsets basically means that those carbon credits that you buy from another player that reduces emissions. The main difference with carbon tax, which is another carbon pricing policy instrument, is that in case of carbon tax, we know the price, which is typically preset. However, we don't know how companies or market players will be managing their emissions. Some, for example, would prefer just to pay tax instead of reducing their emissions. So as you can see, there are certain pros and cons of each of the instruments. And by the way, before we move on, a carbon tax can also come in quite different forms. The most evident explicit one is just tax on emitted greenhouse gases above the certain threshold. However, it can also come in more indirect forms, such as, for example, levy on the fossil fuels used, or let's say import tax on coal. These can be also indirectly called carbon pricing instruments. All right, let's move on to the next slide. A little bit more about emission trading. As we mentioned, that's a very important instrument that is being used by a great number of geographers. And one of the most famous instruments of this sort is the European Union Emission Trading Scheme that has been there already for quite a long time. Once again, the certificates are distributed amongst the players. Usually the terms, how they're distributed, are known in advance, or it could be also through auctioning. That's another opportunity. And then basically the players decide how they reduce their own emissions to the certain level, or how they can buy those offsets. And here, an interesting concept comes into place. Those offsets can be actually bought either from the other players within the sector, depending on how ETS scheme is designed, or can be also bought from outside. And for a long time, for example, European Union Emission Trading Scheme allowed for buying offsets from other countries like Malaysia, for instance, to support their internal emission reduction measures. But going forward, what we can see on the market is that those emission trading schemes are becoming more and more sophisticated and more stringent in a way what kind of offsets you could use to compensate for your residual emissions. And we will see that again during the session today. Another important point is that carbon tax instruments actually can also use carbon offsets, again, the way it is designed. And in Singapore, for example, in the next future phase of it, there will be like a 5% allowance of buying offsets from outside to meet the carbon tax requirements. And finally, there are also hybrid schemes. In certain markets, you can see, for example, both carbon tax being implemented for certain industries like power, for instance. And then at the same time, you can have emission trading scheme, for example, introduced for other manufacturing industries. It's not uncommon, I would say, globally. All right, let's move on to the next slide. And you will see that there is quite a large number of jurisdictions around the world that already have various types of emission trading schemes or carbon taxes. There are 65 as per the most recent World Bank report and dashboard. And in particular, in our region, in Asia, we already have in place carbon tax in Singapore. Indonesia has just recently introduced a carbon tax, which is about to be implemented, and as well as the pilot emission trading scheme. In Thailand, we have also seen the domestic offsetting mechanism, which we'll talk about during today's session. Obviously, China is a very large market that has recently introduced its own carbon pricing instrument as well, and many other countries here too. Very important point, currently the emission trading schemes or carbon taxes cover more than 20% of global greenhouse gas emissions. And on the next slide, you will see how fast the coverage of those carbon pricing instruments is increasing, even compared with the previous year, and mostly thanks to the addition of the China emission trading scheme over the past year. One important point I would like to make here, even though in Malaysia, we may not have yet an explicit carbon tax or emission trading scheme. We'll talk about this in the second session, what are the prospects, but because a lot of Malaysia businesses are also connected with other countries where those carbon pricing instruments may be already in place, this is definitely something you can start thinking about, how those carbon pricing instruments elsewhere can impact your investments, can impact your exports, for example, exports of your products, and how competitive that they would be with this in these markets with these carbon pricing policies in place. Next slide, please. Last slide I wanted to show you in this first introductory part is about the relatively new scheme, which is called CORSIA in short, Carbon Offsetting and Reduction Scheme for International Aviation. So it's been introduced back in 2019, starting with just monitoring, reporting, and verification, understanding the baseline emissions for the global aviation industry. And Malaysia is a part of CORSIA, including its large international air companies like AirAsia or Malaysian Airlines. So what's important here is going forward, air companies that have international flights will be subject to greenhouse gas emission reduction targets under this CORSIA scheme. And to compensate for those emissions that cannot be reduced, companies would need to buy carbon offsets. And obviously, that's both a new challenge for Malaysia, especially for Malaysia aviation companies, but it's also an opportunity for investments, but also for companies who potentially can supply those offsetting projects for the aviation, and not just for Malaysian companies, but for global aviation from, for example, Natural Climate Solutions in Malaysia. Great, let's move on to the next part, which will be now application of those carbon pricing instruments to the benefits of companies' climate targets and ambitions. And here, when we talk about companies, we mean obviously also all kinds of organizations, including financial institutions. And before we start, I would also like to go through a short Menti poll to understand a little bit where you are with your climate ambitions. And let's go to the first question in this second poll. And the first question is, does the organization already have a climate target? Let's see. All right, many participants already say yes, which is great to see. Some are planning to set such a target, some no, but considering, and I'm really happy to see no answers to the answer no. Wonderful. We can continue with the poll, but I can already see that the vast majority already has a target. Then the next question will be exactly to those who either already have this target or planning to have such. What kind of target you have? Okay, excellent. We can see vast variety and net zero, carbon neutrality with different years. Some reductions like 20% reduction in 5 years. All right, so a great combination of near-term and longer-term targets that we can see. Excellent. And then we have one more question. Does the organization already use carbon credits or renewable energy certificates to support your climate targets or actions? Yes, considering in the near future. No, but considering. No. Good, and we can see quite a wide range of answers, quite equally distributed amongst those options. All right, interesting. Let's see, maybe after this session, you may change your mind towards either using those carbon offsets or maybe using them less. Let's see. Great, thank you very much for your active participation. And let's move on to the first slide of this section. Next slide, please. So when we talk about carbon pricing or climate targets, first of all, there are two types: compliance or mandatory and voluntary. Compliance means that in your geography and in your sector, you already have, say, carbon tax or emission trading scheme, or some kind of cap under which you cannot release more emissions than you are allowed to. And basically, everything that would support this target would be fall under compliance market. And then voluntary market or voluntary targets actions is where companies, for example, organizations, set their own targets just because they would like to demonstrate their climate leadership, they would like to transform the business, meet their investors' requirements, or like potential new regulations coming up in the market. There are also hybrid schemes. We saw CORSIA, for example, that has voluntary phase to be followed by a mandatory phase. So in many cases, when we see even mandatory carbon taxes or emission trading schemes introduced, they also have pilot or voluntary phase first. But this is an important distinction because when we'll be talking about offsetting and a lot of different things today, you would always need to think whether it's to meet the regulations or whether it's voluntary. Next slide, please. Another important concept for us to understand is the difference between carbon offsets and renewable energy certificates. The principle is the same. It's the monetization of some sort in the form of credit from the low carbon project. When we talk about carbon offsets, this could be any type of project that leads to emission reductions. It could come from energy efficiency, waste management, renewable energy introduction, as well as natural climate solutions, as we call them. In case of renewable energy certificates, by the nature of the name, it's definitely linked to just renewable energy projects. What is important here is that carbon offsets could be used by organizations to offset their scope 1, 2, and 3 emissions along the value chain. Whereas when we talk about renewable energy certificates, those could only be used to offset your scope 2 emissions, which are linked to purchased energy. An interesting distinction under international frameworks or standards for target setting, such as net zero or a science-based target initiative, is that typically renewable energy certificates are well adopted and well recognized as a equal means to offset the scope 2 emissions to switching to just actual physical renewable energy supply. So it's really widely adopted. Whereas when we talk about carbon offsets, there is a growing trend to reduced use of offsets as compared to your own mitigation measures, and some very stringent standards, like for instance, Science-Based Targets Initiative has very clear limitation on opportunity to use offsets to say 10% only if we talk about the net zero standard by 2050, and no use of offsets whatsoever for near-term targets. So that's probably a very important differentiator between the two types of credits. Let's move on to the next slide. And you will see exactly that point and the main differentiator between what we call carbon neutrality and net zero. In the ideal world, under net zero, we understand that the emissions are offset only with carbon removal project types, really linked to the nature-based solutions and projects that lead to carbon sequestration. All kinds of offsets are actually not allowed under net zero, except for those carbon removal projects. However, it's also well understood that for organizations, it's very hard to achieve net zero already now, because obviously many have emissions that are hard to abate already at this stage, given the level of commercialization of technologies and their feasibility in certain markets. So it's understood that in the near term, as you can see on this graph, to compensate for hard to abate emissions, companies and organizations can still buy carbon offsets, which is the gray bar on this slide. Whereas over time, the share of offsets in your carbon mitigation measures would be reducing to give room to more internal mitigation measures and carbon removal project types. And just to finish off with the slide, on the left-hand side, you also see a very typical journey for any company that would like to reduce its emissions and achieve climate targets, starting from identifying your baseline and setting base year to careful measurement of your greenhouse gas emissions each year, then setting targets, which sometimes can be also the first step. You first set the target and then define the roadmap. Then, of course, you reduce your emissions by all means and through offsetting where possible. And also you communicate your achievements on an annual basis, for instance, through sustainability reports. Next slide, also just an illustration, another illustration to differentiate between carbon neutrality and net zero. Once again, in carbon neutrality terms, you can offset your emissions almost up to 100%, and you can do it already now. And we see it a lot, for instance, done by transportation companies that would like to claim to their passengers that they're using carbon neutral transportation means. We also see carbon neutrality applied a lot to products, not to organizations, but to products. For example, carbon neutral oil, carbon neutral LNG, and so on. Whereas under net zero, it's much more stringent. You really can compensate for hard to abate emissions through carbon removal measures, and mostly from natural climate projects. And once again, RECs can be used under both carbon neutrality and net zero, and they are fully eligible. Right, moving on. Another important concept for us to understand is the difference between offsetting and insetting. Offsetting, I think it's pretty much clear. So that's where you support emission reduction or sequestration projects somewhere else, and then just buy credits this way, co-investing in the project indirectly. In case of insetting, that's investment into the emission reduction or sequestration project somewhere along your value chain, which may impact directly or indirectly your scope 1 to 3 emissions. And the main difference is in case of offsetting, you really need to buy the actual certificate. So the project has to be certified under one of the offsetting standards, and the emission reductions or emission removals have to be verified by a third party. In case of insetting, it's actually considered as part of your internal mitigation measures along your value chain. And unless you would like to sell credits from those projects, you really don't need to certify it through the internationally or domestically recognized certification standards. It's really part of your mitigation measures, and you can just report it in your GHG, together with your GHG inventory and sustainability reports. And as we can see, insetting, as it is not offsetting per se, is very well recognized by international standards like SBTi Net Zero, for example. All right, moving on. That's a busy slide, but the main concept here is that globally there is a big shift towards high quality offsets. Previously, when the carbon market has been just established, there were all kind of projects and different carbon units available on the markets. But more and more, we see the global community shifting from projects that lead mostly to avoided emissions, such as renewable energy or energy efficiency, and also projects that are becoming more commercially attractive and like not highly additional to projects that are yet needing additional support to become commercially attractive. And here on the slide, you will see some of the key principles of carbon offsets, what makes them high quality, and the key internationally recognized standards for carbon offsets certification. And I think the next slide will show you exactly what I meant by the transition towards high quality and additional project types. So traditionally, there were a lot of offsets from the renewable energy, energy efficiency project types. And actually carbon markets helped make those projects commercially attractive as well over time. But now you can see that there is a big shift towards projects with more additional benefits that are not yet commercially attractive, such as, for example, carbon removal projects or carbon capture and storage. And we will see on the next slide that those are more and more prioritized on the global carbon market. Next slide, please. Yeah, thank you very much. And a few more clicks. Great, thanks. So the bar chart shows you exactly that the red area, which are nature-related carbon projects, have been increasing quite rapidly over the last decade. And their share, we foresee, will be increasing more and more. And one of the reasons is exactly the stringency of those international standards, how organizations can set their targets. So if Net Zero says that only carbon removal projects from nature climate solutions can be eligible, that really drives the more demand for those project types. Lastly, on the left-hand side, you will see a typical process for any carbon project registration, starting from registration with one of the eligible certification schemes. Then it has to be annual monitoring of reduced emissions or removed emissions, verification by a third party, and reporting. And only after that, the transaction can happen on an annual basis. All right, moving on to some examples of the carbon schemes, carbon certification schemes available. I won't stop here for long. You will see that there are many, but unfortunately in Malaysia, not all of them are present, and we will talk about this on the second session. Great. For the sake of time, I suggest we move straight to slide 37. I think that would be the most interesting case for us to show how organizations can participate in the carbon offsetting. And we can skip this in a couple of next slides and go straight to 37. Two more. Next one, please. Next slide, please. So in principle, there are various ways how organizations can participate in the carbon offsetting project. Since we have the majority of us present here today from the financial sector, your main box will be on the left-hand side. So you can really be the investor of the project that leads to carbon removals or carbon reductions. But if you are, for example, a business, an organization that would like to buy carbon reductions as offsets, you can either buy it from the existing registered platforms or directly from directly or from the broker, or actually participate in this project also as co-investor from the very early stages. And this is what we can see as the big emerging trend in South and Southeast Asia, where companies start investing themselves in climate-related projects. This way they have better ownership and control over the quality of offsets that they receive. And if this project is done within your value chain, then that would be actually insetting project. Great. Let's move on to just a couple of case studies we have for what ERM has done in this space with our clients. The first example would be more on the supply side. So that was a solar PV developer, quite active in our region, including in Malaysia, and their investor. So for those two client organizations, we developed a market study across South and Southeast Asia, how they can monetize credits from the renewable energy projects they invest in or develop, and convert it into renewable energy certificates or carbon offsets to be tradable in our markets. And some results of the study we will show you today during the Malaysia session. Another case study is the other way around. As for the buying company, it's an international automotive conglomerate with presence in Malaysia, and they were really interested in seeing how they can buy carbon offsets or renewable energy certificates in Malaysia for their local facilities. And again, we conducted quite in-depth study of potential options and project types from which they can buy offsets or renewable energy certificates. So the first example was more on the seller side. The second example was more on the buyer side. And the third example is neither to sell nor to buy carbon credits. It's a very good example of insetting project when an oil and gas company, in this case, it's present in Indonesia, Thailand, and the Middle East, decided to invest in carbon sequestration projects. But instead of selling them to the market, they just give them those emission reductions or removals rather, towards their own climate targets. But what ERM helped them is to develop an internal methodology that could help them calculate the sequestrated carbon from those projects to be able to credibly report on those emission removals in their GHG inventory in the sustainability report. With this, I will close this session, and we have a very short last session before we pass it on to Tirapon. And a quick question before then. What do you think could be your organization's role in the carbon pricing mechanisms in Malaysia? Whether you would be buyer, seller, investor, policymaker, intermediary. Oh, quite a great variety of answers, from purchase of offsets or RECs to advisory role, intermediary role, investor, supply of credits. Great. And sometimes you can actually play several roles in the process, be investor and purchaser at the same time, as we saw on the previous slide. Great. Thank you very much. And moving on to the last bit. I saw in the chat box, one of you have asked the question about carbon pricing instruments in the ASEAN. That's exactly what we'll talk about now. A quick overview. ASEAN and some key markets for us, which are European Union and China. European Union is just the global climate leader, and it was one of the first markets that introduced internal carbon pricing within its jurisdiction. And currently you can see that the average cost of the certificates on EU ETS is about 27, but actually the most recent data even says $50 per ton of CO2. In China, as we saw on the previous slide, there is a new Chinese emission trading scheme recently introduced, with the average cost of carbon being about $11. And now we will talk about Thailand, Singapore, and Indonesia in more detail. In Thailand, we have only emission trading scheme, and which is voluntary. In Singapore, we have tax, which is mandatory. And in Indonesia, we have plans to introduce carbon tax and emission trading scheme at the same time. Let's move on, please. We'll start with Singapore. I believe many of you have business or connections with Singapore, so it's very good to understand that in Singapore we already have carbon tax in place since 2019, which is currently at just $5 per ton of CO2, but the government plans to gradually increase it. And which is great about Singapore carbon tax, this price increase is very transparent. So investors and companies can plan their activities ahead, knowing how the carbon price will behave in the future. And as I mentioned before, from 2024, companies that are subject to the carbon tax would be also allowed to buy offsets up to 5% of their allowances. And as of now, only large emitters that have more than 25,000 ton of CO2 equivalent emissions per year are subject to the carbon tax, not all companies. Next slide just quickly shows you that there are a few carbon exchange platforms available in Singapore. I won't touch upon this in detail, but if you have questions, we can get back to this slide later. But that's definitely becoming, Singapore is becoming the carbon hub of ASEAN for sure in the coming years. Next is Thailand, and actually I would like to introduce to you Tirapon, who comes from Thailand, and he will talk a little bit about Thailand case.
Yes, thank you. I'm very happy to do so. So Thailand has been considering carbon legislation for a very long time. And from what URM gathers from our stakeholders that we engage with, there's been a delay because of some disagreements on the actual final policy that will be in place. Nevertheless, as part of the roadmap towards the legislation on carbon pricing in Thailand, which is due before 2030, there has been this scheme. It's called the Thailand Voluntary Emissions Reduction Scheme, and its real purpose is to help the government test the waters, have some key players in the industry test what would happen if there was an emissions trading scheme, how ready are the participants, and what mechanisms need to be in place in terms of MRV measurement, reporting, and verification. And so this program was quite successful. So there were a large number of voluntary participants, and that other than the voluntary emissions reduction program, which produces carbon credits for those that are interested in the carbon credit market and carbon neutrality. But there was also another program called the TVETS, or the Voluntary Emissions Trading Scheme, which basically was set up to test the emissions trading. So there were a large number of projects, and the amount of global emissions reductions here are not insignificant, so around 5 million tons versus the national number for 300 million tons, and a variety of sectors were included and participated. And the discoveries on this side, on the government side, will help to influence the way that they set the policy in the future. Thank you. Back to you, Julia.
Thank you very much, Tirapon. And on the next slide, you will see an excellent example from one of the companies in Thailand, which we have worked with. It's Bangkok Transit Transportation System, BTS Group, that asked KREM to help them in finding good carbon offsets and renewable energy certificates to help them claim their carbon neutrality. And actually, thanks also to our efforts and to great teamwork from BTS staff as well, they have achieved the carbon neutrality and received the certification by under TGO and TIVR scheme. Great, let's move on to the last but not the least market for us, which is Indonesia. And it's a great example of a market where both carbon tax and emission trading schemes are being introduced. Initially, carbon tax was planned to be introduced already in April this year, but unfortunately, due to the global economic situation, it's been postponed till July. And currently, it's at 2.1 ton of per ton of CO2 emissions. Not high, but it definitely sends a signal that the price will be there and potentially will be increasing over time. And on the next slide, you will see that emission trading scheme is also being planned. And in addition to that, Indonesia government, similarly to Thailand, is introducing domestic offsetting scheme. So to complement the internationally available standards like verified carbon standard, gold standard, or clean development mechanism available in Indonesia, the government would like to develop its own offsetting scheme so that there are own methodologies adjustable to local context, as well as all the documentation could be provided in local language versus international standards. And I'm pretty sure that something similar will be sooner or later introduced in Malaysia as well. So Indonesia and Thailand, in this sense, are good markets to look at as examples. I believe that's it from my side. I suggest we pass on to Tirapon to finish off with his part on internal carbon pricing, since he needs to leave, and then we will pick up questions from the floor. Tirapon, over to you.
Yes, thank you very much. So you may also park your questions in the chat box, of course, and we will have that separate Q&A session later. So just to link between what Yulia just mentioned in terms of regulatory carbon pricing and all sorts of other different carbon pricing, a simple way to look at internal carbon pricing is a way that companies are reacting to the external pressures, whether they be from stakeholders, from the actual regulation, or impending regulation, uncertainties in regulation that could be changing in the future. Therefore, it's a different set of pricing and a sort of a different set of rationale. The purpose of regulatory carbon pricing is to drive the market towards lower carbon and to raise funds from the carbon pricing to invest into lower carbon energy. For internal carbon pricing, it's really focused on the company. What does the company what is their viewpoint in terms of the reaction to the carbon pricing? What will they do to react with the external carbon pricing? And then therefore, what will they do in terms of the internal carbon pricing? And the main ways that internal carbon pricing are used in terms of business and investment decisions. So putting that carbon pricing as a factor, another part of the equation of your business and investment decisions. For example, integrating carbon cost as a part of the cost in your financial projections. And also as a way similar to what the government is doing, sort of trying to raise funds to enable the low carbon investments in renewable energy within the company. So this is very specific for on the private side or on the company side or the corporate side. So internal carbon pricing is really only used by corporates. And on the regulatory side, of course, then there's things like carbon tax, cap and trade. These are two completely separate ideas. Internal carbon pricing only used for companies. Yes, let's move on. So, these are some broad approaches in terms of setting carbon pricing. I won't go into too much detail, but there are some common sense things that need to be thought about in terms of setting a carbon price. But in reality, it's quite a bit more complex than this. It will require internal engagement with your internal stakeholders, agreement with people at operations side, for example, and also your senior management, your executives on the implementation of a carbon price. But the four main parts. One that I've already mentioned is engaging those stakeholders within the business so that they understand what the carbon price is and how it might look. And then with these stakeholders designing what the best approach is for the company. Each company is different, of course, and different sectors will have different approaches. Then having some sort of pilot testing, rolling out the internal carbon pricing, seeing if you integrate the carbon pricing into your projects, how it would look like. And then finally, with the real rollout and continuing to monitor and evaluate the internal carbon pricing. The actual carbon price may evolve over time like it does on the regulatory side. And that's something that the company will need to update on an annual basis. So these are the four steps. And in terms of the dimensions, so there's the actual pricing. What is the numerical number? Let's say US dollars per ton of carbon dioxide. How wide will you go in your value chain? Will you go upstream as well, or just in your operations? Will you also include downstream or not? How deep will it influence the business decisions? Will it be just for sensitivity purposes, or will it be integrated into the overall business strategy? And over time, how would the carbon price develop? So these are some key principles as recommended by CDP, but of course in practice, it may be a bit more complex than this. So the main benefits of setting an internal carbon pricing, I think that there are many. I won't go through each of these points, but I think the main one at the moment, especially in this region, is around future proofing, really. At the moment, the carbon price is zero, but to put a valuation on carbon price in the future as zero is not accurate. In the future, many governments have already have plans to have a carbon price in place, and therefore, to future-proof the company, you should have setting a carbon price that is in the future. And the other main part in this region may be in terms of the investor pressure. So it's not necessarily a regulatory pressure, but a voluntary pressure from your investors to start thinking about carbon pricing. And after this, I think there was a question in terms of practical examples. We will have some practical examples as well to follow. Yes, let's move on. Sorry, yeah, okay. Kieran, maybe I would like to maybe skip the slide, and then maybe we can go straight into the examples. Yes, okay, so why do companies use carbon pricing? And to answer this, as I mentioned already, the main driver for carbon pricing is on the regulatory side. Or if regulations are not yet in place, then it is something that the companies can project what could be happening in the future. So in this picture, this is showing the regulatory carbon pricing. So the governments implement a carbon price to be paid by polluters. And on the right-hand side, this could be your company. Then you need to pay some sort of carbon price to the government. And from your point of view, the internal carbon price is something that can be used to integrate this carbon cost, whether it be present or future, into your financials. We will show you some other examples where some companies also use the internal carbon pricing model as a way to raise funds for renewable energy, very much in a similar way that the government does. Okay, maybe we can move forward to the next slide. Okay, so I'll just go quickly through this, but we just want to show that year on year for the from 2018 to 2020, more and more companies, if in Asia, are having a global internal carbon pricing. So it's becoming more and more valid, and even more companies in Asia than in other industries. This is the percentage coverage by different industries. So you can see clearly that for fossil fuels and power, because they are the ones with the most pressure and the most stake, they produce the most amount of greenhouse gas emissions, and therefore likely the most amount of impact in terms of the carbon pricing. So they have highly adopted these the carbon pricing as part of their model. Of course, other industries are following along. To note, financial services is roughly 50% as of that survey in 2020. Now talking about the different pricing levels. Basically in terms of internal carbon pricing, if you want to drive some sort of change in your organization, of course, the price needs to be higher. According to this carbon pricing pathway, the sort of step that starts to take change is around $20 to $50. So this is applicable both for internal carbon pricing as well as for regulatory carbon pricing. Any pricing lower than that, up to $20 would be considered as introductory, maybe a pilot phase or a starting phase of the carbon pricing. And as you move from $50 upwards to above $80, any sort of pricing like this will be highly targeting for a shift towards renewable energy, low carbon energy. Okay. Okay, so now we will have the three main types of carbon pricing that are used in the organization. The first is in terms of what we call an internal tax fee and cap. The second is called a shadow price, and the final one is called implicit carbon price. The most commonly used of these three is called the shadow price, and that is because as mentioned, is quite practical. It's a theoretical internal cost that can be used for the project planning to include an additional cost in addition to other operational costs that are already evaluated to help to screen potential business risks of the future regulations. Especially in jurisdictions that don't already have a carbon price, you can put an estimated or a series of scenarios where different ranges of carbon pricing could be affecting your business. The next most popular is in terms of the internal tax fee and cap, and we will have some practical examples later, but this is basically like it says, is similar to carbon tax or cap and trade, but the boundary is within the company itself. So different business units or different parts of the business will be having set targets, and if they produce emissions above those targets, then they will need to contribute monetarily to an internal fund that will be used to drive renewable energy investments. And finally is the implicit carbon price. So this is a more practical use of how much it actually takes. What's the cost to reduce your greenhouse gas emissions? So the purpose is slightly different. This is to find which greenhouse gas reduction measures would be most suitable for your organization. Okay, so can we move on, please? In terms of the price range, of course, for shadow price, because this really depends on the viewpoint of the company, what their view is on the future price and what their view is in terms of the carbon risk to them. So there's a very large range from $0.3 to $906. But we would say that for the most part, shadow price would be around $20. internal tax fee and cap is lower than the shadow price, because this is an actual price that the different business units need to pay to raise the revenues for the greenhouse gas. And for implicit carbon prices, is typically a confidential number that companies don't disclose. In terms of internal tax and fee and cap, the investments are this is an actual money that is actually used by the company, and the revenues from the internal tax and fee are used to fund sustainability projects. There's actual transactions being made, an actual payment being made by the business units to the corporate to help to raise funds for the renewable energy, and that money is actually being used for renewable energy projects. Next, in terms of shadow price, as mentioned already, there's no actual payment or collection of the shadow price. It is more used for feasibility to see how feasible your projects are over time, and if there was a carbon price attached, or if there's a carbon price that is rising from now, how would that affect the cash flow of your operations? And then finally, also for implicit carbon price, there's no actual investment or revenue made from here. This is just the price that is derived from previous data, and it will be used to help in investment decisions on what greenhouse gas reduction types that you would use. And then I also note that in terms of on the finance side, we do have a lot of finance people joining. I think shadow price is typically the most useful way. It's the way to help you screen your clients. It's to help in the lending process, the decision making before you lend to your clients, analyzing whether as an additional part of your financial assessment and your continued assessment of those clients that you lend to over time. Okay, and then in terms of actual examples, so Microsoft is one example for the internal tax. So they do exactly what I say, and for each of the different business units of Microsoft, they are set with a greenhouse gas target. If any of those business units emits any emissions over, let's say they emit over the target by 1,000 tons, and let's say Microsoft uses a carbon price of $20, so they will need to pay $20,000 into the internal carbon fund of Microsoft, and the managers of that fund will then allocate those funds to invest in renewable energy projects or other projects that reduce carbon emissions. In terms of shadow price, actually, there may be hundreds of companies that use this method, but we've highlighted some in this region. And as mentioned, there's a theoretical cost. And in terms of implicit price, we have found one example, which is from Vodafone in terms of that price. And the next, I think we have 2 case studies of the actual price. And a great resource for those that are new to internal carbon pricing is the CDP project, CDP, or previously known as Carbon Disclosure Project. And you can find companies that are adjacent to yours in the same industry as yours and see and benchmark and see what they are doing in terms of carbon pricing. And so the actual disclosure that they will show what type of price they're using. So in this example, PTTGC, a petrochemical company, uses the shadow price. They say that they use a around $20 price, and they have various different objectives. Actually, this is covering all of the objectives available on the CDP to navigate greenhouse gas regulations, stakeholder expectations, etc. And they've shown the specific application where they have joined the Thailand Voluntary Emissions Trading Scheme and used that pilot project to reduce greenhouse gas emissions and to sort of test their carbon pricing. And they have some more details in terms of which scopes that they look at in terms of scopes 1, 2, and 3. The Vodafone, this example is because it's implicit price. So this means that on average, Vodafone spends 10 euros per ton of greenhouse gas emissions that they reduce. And the scope of this is for scope 2. So this is for improving the electrical efficiency or driving renewable energy in their company. And this price is used as a benchmark so that basically any projects where the price of carbon to reduce the carbon is above 10 euros, that would be less feasible, whereas less than 10 euros would be more feasible. And that would be the way that they implemented this in their internal carbon price. Of course, various different companies will have different approaches. And as I mentioned, an important part is the viewpoint of the company. What was the company's view on the carbon risks? And then that will be reflected in the level of the carbon price and also how they use the carbon price. Okay. So we have a quick poll here. From what I mentioned, what do you think are the two main types of the emissions, the carbon pricing? So this is basically just testing if you've been listening, and thank you very much. I'm glad that the majority of you have been listening well. So the two main types of carbon pricing on the regulatory side are in terms of carbon tax and emissions trading scheme. Thank you very much for that. Okay. So which carbon reduction approach represents the following scenario? Kevin, I think, are we missing the scenario?
So you should be able to see the scenario in the description on your phones when you're submitting.
Oh, okay.
Yeah.
So they can see it. Great. Okay, that's great. I'm glad to know that 100% if you have answered right on that one.
Yeah. Many thanks, Tirapon, and many thanks, Julia.
Thank you, everyone. Bye-bye. Thank you.
Yep. Yeah, I think in the last 1 hour, we covered a lot of like the concepts. This from like carbon offsetting to insetting, from like carbon neutral, net zero. We also talk about carbon pricing development in some of the ASEAN countries, Singapore, Thailand, Indonesia. And also Tirapon shared a lot on the internal carbon pricing, the internal tax, shadow price, indirect carbon tax. So there's a lot of literature being covered over the last sort of 60 minutes. Now, I'd actually like to, before Tirapon move on, I'd like to actually address some of the questions raised. There's a lot of questions being raised on the Q&A and the chat, and appreciate all the audience. Can you please put your question on the Q&A session instead of the chat, please? Yeah. Tirapon, there are a couple of questions maybe addressed to you first.
He has left already. He has apologized and left. So maybe on internal carbon pricing, what I will suggest, we'll pick up the questions and follow up with these with the participants with our responses in writing after. But I can pick up questions related to my part, no problem.
Okay, good. Yulia, I think this first question raised is like, how does the price of carbon tax inform internal carbon pricing and price of external carbon credit? Does low carbon tax equal to low carbon prices?
Yeah, that's a tricky question. There are quite a lot of components to that. And honestly, when we perform internal carbon pricing modeling for our clients, we have to look into quite a few different parameters there. I would say generally, yes, there is a correlation between what would be the carbon tax in a specific market and what should be the internal carbon price set by a company. But it also depends on how much outwards your company is looking. For instance, whether or not you would be trading with the European Union or other markets that may have higher carbon pricing in place. So that would definitely also impact that, as well as your emission reduction initiatives, how fast your business is going to transform to low carbon pathway. So all of those factors, amongst others, would be taken into account. But yes, in short, the future carbon price in the market would be the first thing to look at.
Yep. And Yulia, there's also a question to ask. Is there any cons on the ETS system?
Yeah, that's a good question. Actually, there was another question similar on what are the cons on carbon tax in the chat. As I mentioned, the main differentiator between the two is that in case of carbon tax, we know the price. But this price actually may be not relevant to what is currently market says. It may be way too low. It may be, well, rarely way too high, but it can be quite lower than what market can offer. In case of ETS, actually the market dictates the price. That's a benefit of it. But on the other hand side, we don't really know how much emissions would be potentially reduced through that mechanism. We know like how much is allowed to emit, but then emission reduction efforts is a big unknown. And in addition to that, carbon tax is also can have bad perception in certain markets. And I know for the fact, like we work with one of the countries in ASEAN to see whether the country should introduce carbon tax or emissions trading scheme. And one of the main concerns of the government was that carbon tax would not be welcomed by the public. Unfortunately, even though it may be much more straightforward, could be better regulated by the government, but that's not what the market would welcome.
Yeah, thanks, Yulia. There's also a very interesting question from Wei Long Ham. With difference in carbon tax in different countries, would a company move its carbon intensive operation to country with no or low carbon tax? Are there any measure to avoid?
Yeah, that's called carbon leakage. Yeah, there is a
Yeah.
term for that.
Yeah.
And in fact, somewhat that's unfortunately happening. I wouldn't call the name of the country that is doing this already, but yes, unfortunately that's happening. Well, basically what's happening right now is compared to the previous Kyoto Protocol world and the Paris Agreement, all countries in the world, or almost all countries, have climate targets. And sooner or later, it means that countries will be introducing policies and measures to address those emissions. And as we saw today, carbon pricing is one of the most typical ways of how countries do that. So in our perception, the majority of countries will have carbon pricing of whatever sort in place sooner or later. Another factor is that countries and big companies in those countries are also pushed by investors, by foreign stakeholders to speed up their policies, regulations towards low carbon economy transition. You saw already, for example, after COP26 last year, there were quite a few initiatives like phase down coal investments, for example, or reduction of methane emissions that were signed by a lot of companies, but also by financial institutions. Yep. So definitely there is a global trend towards decarbonization, but in the short term, yes, carbon leakage will probably be happening, unfortunately.
Yeah, maybe Yulia also want to add a point. In the COP26 last November in Glasgow, I think 40% of the world sort of financial institutions have already pledged to net zero by 2050. That is equivalent to 140 trillion US dollars of funds already pledged to. That will certainly have a very big influence into the financial community and flow down to the corporation, I would say. Yep. Maybe one more question. I'm mindful of time, Yulia. Is there any question you'd like to pick up? There's one talk about what role does intermediaries play in existing VCM market globally?
Yeah, that's a good question. There were a lot of discussions on the future of the voluntary carbon market. And the main concern is that before, again, under Kyoto Protocol, only developed countries had targets and all developing countries did not. They were like endless suppliers of carbon credits, basically, for developed markets. But in the new realities of Paris Agreement, every country, every market has their targets. And when it comes to cross-country trading of carbon offsets, the biggest concern that like the global community and governments in the first place have is how we deal with those emission reductions that happen in one country and then they get transferred to another country, and how that would affect the climate targets of a host country in the first place. Like this topic is called corresponding adjustments under the like climate negotiations. So that was quite a concern for the voluntary market that is in principle quite cross-border in nature. So definitely, well, the first role that intermediaries could play is of course shaping up how the voluntary market would look like. I know that there is a task force for scaling up voluntary carbon market, and intermediary organizations play quite a visible role there, helping define the rules and like how the market would behave. Obviously helping the companies finding those high quality offsets that we have been talking about, because you can easily get lost in the landscape of projects, offset types and standards, and intermediaries play a good role in holding you through this process, right? Many of those intermediaries are actually involved in projects development themselves, so they know from their boots experience what would be the good and what would be not so good on the market.
Yep. Thanks, Julia. I'm mindful of time. We have another 40 minutes to go for this webinar. I suggest we move on. Yep, Kevin and Chin, you ready for the Malaysian sessions? Yeah, please proceed. Thank you.
Thank you, SK. Thank you for the interesting session on the landscape and from the overall concept and also the regional approach. And also now we zoom into Malaysia, right? So we will see what is the carbon market like in Malaysia, what was announced and what will be planned for this. Yeah, Malaysia has signed both the Kyoto Protocol and the Paris Agreement committed in our carbon emission reduction. Yeah, our CO2 emission relatively to other ASEAN countries, you can see from the graph, right? We are among the major emitter after Indonesia. I mean, standing among Thailand, Vietnam, emitting about 250 million tons of CO2 in 2020, right? So Malaysia's carbon market is currently not too active. Yeah, prior to trading, we need to implement a carbon pricing policy to help in our national determined contribution NDC goal in place, right? From the graph, you can see that CO2 emission from the energy combustion increased at a high rate from year 2000 to 2008, but the growth rate has been halved between 2009 to 2019. Reduced from 6.5% to 3%. Yeah, let's look at what do we have right now in Malaysia. Next slide. In the 12th Malaysia Plan announced end of last year, Malaysia aims to be a carbon neutral country. There are a few carbon pricing mechanisms that can help us. This is due to carbon pricing mechanism put an economic value on carbon emission. This carbon price is to be paid by the parties responsible for the emission. And so the burden for environmental harm is being shifted back to those who are best placed to reduce it. Yeah, polluter pay principle as well, right? So we have the carbon tax and also the domestic carbon emission trading system, ETS, and also the carbon border adjustment mechanism. Yeah, some of us asked about the cross-country, right, issues, and this will be one of the policy that can address that. First of all, we talk about the carbon tax, right? A carbon tax is levied on carbon emission required to produce goods and services. The two approaches to taxing carbon as identified by the United Nations Tax Committee are from the fuel approach and also from the direct emission approach. The fuel approach imposes a tax on fossil fuel, such as from the for the oil and gas industry, the coal and the derivative products. Tax rates are determined by volume and weight units based on the average carbon content of each of the fuel type, which can be then charged anywhere within the carbon supply chain, whether it's from extraction, importation, or consumption, right? Governments may customize the approach depending on the needs and priority of the country. Yeah. Conversely, the direct emission approach imposes a carbon tax on greenhouse gases as mentioned in the source, at the source, right? Generally, the taxpayer will be the entities that produce or physically generate the emission, right? As of now, Malaysia is planning to implement this. It was announced end of last year, right? Like during October, right? Last year, right? The other one is more on the emissions trading system, right? Like what Yulia has mentioned early in her presentation. But what we are opting for will be first to try on the domestic approach, right? So we call it the DETS, right? The interaction between market supply and demand will determine the carbon price, right? So this is internally within Malaysia, to trade within Malaysia, to try out pilot study within selected companies in the coming future, perhaps. There is a fixed cap on the GHG emissions, but permitted for each business, and low carbon emitters may sell their excess credit to companies that exceed the cap. So companies may acquire allowances sufficient to cover their emission through auctions or the allocation of allowances. A perceived advantage of ETS is that it may provide more certainty when planning emission reductions. So government will achieve reduction over time by reducing the cap, right? So this will help Malaysia in that aspect. To execute carbon credit transaction at the domestic level, our Ministry of Finance has also recently proposed to launch of a VCM intends to serve as the voluntarily platform of trading carbon credit between green assets owner and other entities moving towards low carbon practices, right? The other approach, the other policy that to take care of carbon border tax, right, is something that we call CBAM in short. This imposes a broader fee on imports from countries without acceptable carbon pricing policies, right? So producers in countries with stringent emission policies, which increase domestic costs for producing the carbon intensive good. So may also move production of these goods to jurisdiction with lower carbon compliance standards. So this, if this is being implied, this will reduce the hassle of like companies or country to move their production from one country to another. So the EU importers and non-EU producers will have to buy carbon certificates, correspondingly to the carbon price that EU-based producer would have to pay, right? This is the concept moving forward. So we move on to the next slide to look at the VCS program, right? So what are the available programs that is being recognized and being practiced in Malaysia? There are two, like what you are seeing on slide, VERA and the Gold Standard. The VCS program is the world's most widely used voluntary GHG program. So this allows certified projects to run their GHG emission reduction and removal through tradable carbon credits, right? Each VCU represents a reduction or removal of 1 ton of carbon dioxide equivalent, CO2 equivalent, achieved by a project. Right? VCU are also characterized by a number of quality assurance principles, which are confirmed through the project validation and verification process. So ultimately, the purchase and the retired by an end user as a means of offsetting their emission. All VCU issuance and retirement records are publicly available at their website, at VERA's website registry. Right? So the other one is the gold standard. You can purchase carbon credit from the projects certified to gold standard via their website. The gold standard marketplace allows companies to offset their emission with high integrity carbon credits in a simple, transparent way. Retirements are made in public, right? So public registry in the real time and full traceability. All these are being recorded and can be tracked, and certificates to documents to purchase the carbon credits are generated automatically and being sent to you. Yeah, proceeds benefits project developers directly, enable them to maintain and expand the project activity and deliver more climate and sustainable development impact, right? There will be also share value figures has been calculated by applying the value delivered per carbon credit to the relevant gold standard certified projects, right? So for example, the issued carbon credit, right? The calculations include both verified emission reduction and also the gold standard labels, yeah, for the certified emission reduction. Yeah, we move on to the next slide. I would like to introduce 3 recognized renewable energy certificates, right? So these are the common one in Malaysia, the IREC, the TIGRS, and MGETS. So for IREC, it was being launched back then in 2018, right? It's an international market-based instrument, represents the property rights of environmental, social, and other power attributes of renewable electricity generation. So the green certificate company, the GCC we call it, is the sole authorized IREC issuer in Malaysia. So a lot of companies are doing a lot of research, forecasting their future electricity consumption use, and also what are the renewable energy sources that can look for in the future, right? The second one is on the TIGRS. Yeah, Apex is created this TIGR registry, and it's an online platform for tracking and transferring RECs. Right, in 2019, it started in 2019. Malaysia Sustainable Energy Development Authority, the SEDA, signed MOU with Apex and forming the partnership to actually launch this trusted international platform. So the third one is on MGETS, is Malaysia's national marketplace for RECs, established also in 2019. Currently accepts large scale of solar projects. We can see that a lot of solar projects are mushrooming, and one of it is the signing of MOU between TNB with let's say UITM, solar power projects, and other private entities as well. Yeah, MGETS plans to allow private power producers to participate in generating the RECs for local buyers, right? Yeah. We move on to next slide. So the next question for us in Malaysia is how to monetize the ESC in Malaysia, right? The RECs. So ERM assessed that Malaysia has been very slow due to many factors to develop ESCs, yeah, due to past and ongoing net metering policies. Yeah, we have launched policies like green electricity supply since like 15 years ago, but things are still moving very slowly. The government has introduced the net energy metering scheme, right? November 2016. And then there are quotas like 500 megawatt up to year of 2020, right, 2 years ago, and to encourage Malaysia's RECs, right, a renewable energy uptake. But because of solar project owners can already sell electricity back to the grid, to the TNB grid, national grid, so there is no incentive for solar developer to actually REC buyers to sell and buy RECs. In this case. So how are we going to move forward in this to encourage more credits to be generated in the market, and then enhance the coming trading and also become the center of trading hub in Malaysia. So to try out this will take some time. Okay. I will like Kevin to share with you what are the types of market players that we have in Malaysia, right? Pass to you, Kevin.
Right, thanks, Shin. Hope everyone can hear me well. So to continue on with our discourse on carbon pricing in Malaysia, I'd like to provide us with an overview of the 4 types of key market players here in Malaysia. So we have project developers, EAC issuers, the intermediaries and brokers, as well as the credit purchasers. So if I could start with the first one, so project developers. So these are the entities that help develop and operate GHG emission reduction projects here in Malaysia in our context, which includes renewable energy that can help be generated into EACs. But we should also note that the project developers that we've stated here, so Constant Energy, ENGIE, SkyTech, and SolarVest, these are quite solar specific, since solar energy has been quite a strong focus of our government, especially here in Peninsular Malaysia. But it's also important to point out that hydropower has continued to grow in East Malaysia and is quite prevalent, especially in Sarawak. Moving on to the EAC issuers. So these are the entities that help set the guidelines or get authorization to help companies issue these EACs and also ensure that these projects make measurable or positive contributions to offsetting carbon emissions or RECs. And the top one there, so GCC, they are the central issuer for IREX, so the International REC Standard, and actually one of the first issuers of IREX. And SEDA on the second row there, they are responsible for the net energy metering, the NEM scheme here in Malaysia, and the UNFCCC are also responsible for the rollout of the CDM. Moving on to the intermediaries as well as the brokers. So these are the entities that then help connect the buyers and the project developers for any trading or exchange purposes. And these can include carbon offset retailers, carbon offset aggregators, which essentially introduce buyers and sellers in the marketplace. But it's also important to note that they do not actually take ownership of the underlying carbon offset credits. So rather what they do is that these brokers just help facilitate the transaction in exchange for a commission or a fee. And lastly, the credit purchasers. So these are entities such as Synergy as well as YTL SV Carbon here in Malaysia, to name a few, that want to offset their carbon emissions generated either by their project activities or such as production or even energy consumption from their headquarters. But this also refers to those who want to help reduce their GHG emissions and increase their sustainability performance through world-leading indices. So indices such as CDP, DJSI, RE100, which are all globally recognized and also considered best practice. But yeah, it's also important to note that as Malaysia is still considered an emerging market, especially for carbon credits, EACs, there haven't been that many key players identified or that have stood out from the pack. Now, to quickly take us through an example of this from one of our clients. So we supported a client here in Malaysia back in 2020 for an RE100 assessment. And this client was they were a Korean copper foil manufacturer, and they were looking to establish a factory in Malaysia as part of their expansion plans for their manufacturing sector. But this company specifically had committed to RE100 and wanted to make sure that their new plant also fulfilled the RE100 criteria. So in terms of our approach, what we helped to do was firstly conduct a screening on the options available here in Malaysia that was in line with the RE100 objectives. But secondly, also to include an assessment of, our scope included an assessment of potential power purchases, self-installation for solar power, as well as the purchase of RECs. And in addition to this, we also helped our client in engaging relevant parties to gather any information on the potential for renewable energy or REC options. So this was engaging stakeholders like solar PV suppliers, power generators, or even REC suppliers. And as part of analysis, we also conducted a CBA, so a cost-benefit analysis to help investigate the most feasible options that were to be implemented. Now, shifting our focus to the future outlook of carbon pricing in Malaysia. So we know that carbon pricing is currently in the early stages of implementation in Malaysia, but we've also seen that neighboring countries or other countries in the ASEAN region have started to implement carbon pricing, and Malaysia, based on their announcements and projections, are also expected to grow in the next few years, but only once carbon pricing mechanisms are formalized. And I'd like to take us through 4 key points. So firstly, with the growth of MGATs. So as Chin mentioned earlier, the primary role of MGATs is for at least at the moment, to register TNB's large-scale solar projects and help sell these RECs to local Malaysian companies with climate commitments, such as RE100 in the example we gave previously. But one thing we wanted to highlight is that if your companies already have a solar project with any off-takers in Malaysia, and MGAT, if it begins to evolve and becomes available to private sector project developers for participation, this actually might present a very strong quick win opportunity for your company. Moving on to the LCET, the low carbon economy transition. So again, we understand that Malaysia has a target of shifting to 31% renewable energy capacity mix by 2025 here in Peninsular Malaysia. And as part of this, we'll be looking to phase out fossil fuel plants such as CFPPs, coal-fired power plants, and replace these with renewable energy options. So this not only signals Malaysia's intention in participating in the LCET transition, but it also highlights the importance of carbon pricing as an instrument or as a tool to ensure that Malaysia doesn't just lag behind, but actually significantly contributes to the carbon pricing global landscape in the near future. Now, moving on to the carbon pricing rollout here in Malaysia. So these figures that we've put here are really based on estimates or case studies that we've observed from other countries in the region. So we discussed Singapore, Thailand, as well as Indonesia in our previous slides. And based on this, we expect Malaysia to need an additional approximately 2 to 3 years to firstly implement their carbon tax and ETS policies. And then in addition to this, another 3 to 5 years to then achieve the implementation objectives. And lastly, moving on to key challenges that we've identified. So I think it's actually good that this was brought up during our Q&A session earlier, but the first key challenge that we believe would be for the government to coordinate their carbon tax and ETS policies to avoid what we call carbon leakage, where carbon-intensive industries relocate to states that either have less strict carbon policies, carbon taxes, or do not impose carbon prices at all. And if this does happen, there must be clear strategies to help assist affected businesses or people, because although the topic of our current webinar is on carbon reduction, the goal is carbon reduction, we're talking about carbon pricing, but it's also important not to have tunnel vision, right? When we think about sustainability, there's 3 key pillars, and outside of the environment, there's also social and economic impacts on people, on businesses that we need to be mindful of. Carbon taxes might lead to rising fuel costs or costs that may be passed on to consumers, which would likely increase cost of living or cost of goods. And especially in our country, which is still a developing country, and people are still recovering from the effects of the pandemic, not everybody can actually afford the effects of carbon pricing policies or mechanisms. So there must be clear strategies, but also consideration put in place around these factors. So shifting our focus to Malaysia's role in the global carbon market. So we see that Malaysia has the potential to play a very large role in the global carbon market landscape. And this is primarily in the form of supplying carbon credits to international voluntary schemes and compliance schemes. I won't go through too much detail in the interest of time, but so Chin has introduced Verra as well as the gold standard. And as part of the VCS standard, I thought I'd share just the 3 key pillars around this. So again, the VCS standard helps lays out the rules and requirements which all projects must follow in order to be certified. But as part of this, the requirements are independent auditing, where this needs to be qualified by independent third parties and also by Verra staff to ensure that these standards are met and properly applied. And secondly, with the accounting methodologies, this is to ensure that projects are assessed using Verra's GHG emission reduction quantification methodology, which is specific to that industry or project type. And lastly, the registry system, which is essentially the core database, the central storehouse for all data to register projects, to track generation, retirement, as well as cancellation of the VCUs. And all this, the supply of carbon credits will then be supplied to international voluntary schemes and compliance schemes. So Yulia, earlier in the presentation, has taken us through a couple of them. So we have Korsha, we have Natural Capital Partners, we have Net Zero. And just to highlight Korsha, especially in particular, and what their link is to VCS and Gold Standard. So actually in March 2020, VCS as well as Gold Standard were accepted as only 2 of 6 programs globally that were eligible to supply carbon reduction units to Korsha. And Korsha is particularly relevant in Malaysia as well, because as Yulia mentioned, we have AirAsia, we have MAS, and in the endemic phase, we see that the aviation industry has started to grow and slowly boom again in the post-COVID world. So this is in particular relevance as they are one of the largest emitters in terms of industries in the world. But it's also important to note that any cross-border carbon transactions, because they will impact a country's NDCs, is likely to be more strictly regulated. But again, in the new Paris Agreement world, we've yet to see how this is going to be operationalized. So this is definitely something to keep a lookout for in the future. So just a couple of quick examples or case studies to illustrate this. So what we see on the slide here is research conducted by the World Economic Forum, and they're showing the percentage share of NCS potential for countries around the world, for countries that have a potential of 1% and greater. And if we look at the map globally, we can see that Indonesia and Brazil, they stand out with 15%. But if we really draw our focus into the ASEAN region, we actually see that behind Indonesia, Malaysia comes actually in second place with 3%. And this is because Malaysia has a large availability of large-scale rainforests as well as coastlines, with, especially in our coastlines, we have about 4,700 kilometers approximately. And this provides a lot of opportunities for blue carbon initiatives. And blue carbon is essentially when carbon is stored in coastal and marine ecosystems. And these coastal ecosystems such as mangroves or seagrass, these can help either sequester as well as store carbon. So that's definitely one way that Malaysia can play a large role in the global carbon pricing landscape. And just to show one more case study here in Malaysia. So this was more specific to our client, where we helped our client conduct a carbon sequestration potential analysis for the Kota Damansara Community Forest Park. And to quickly go through the objectives, we just wanted to provide a tangible baseline carbon value on the park itself. And what we did was we assisted the communities in trying to convince relevant stakeholders, any investors, to help preserve the forest as the green lung. And the primary objective was to help them understand the potential for storing or sequestering large amounts of carbon within the park itself. And again, based on their management plan that they developed. And as part of the key outcomes of this project, we were able to estimate the amount of carbon sequestered by the park based on the above ground as well as the below ground biomass and its annual carbon stock exchange. And just one more example. So this is from South Pole, Borneo. So just to provide a bit of context for this project. So in 2019, the International Congress for Conservation Biology, ICBB, this Congress was held in Kuala Lumpur back in 2019 by the Society of Conservation Biology, so SCB. And they partnered with South Pole to help participants offset their travel, the emissions from their travel to and from ICBB 2019. And this was selected. So it was a Borneo forest protection here in Malaysia, where they helped to rehabilitate 25,000 hectares of degraded rainforest in the area of Sabah, like via NCS, so nature climate solutions such as tree planting or sustainable forest restoration activities. So to quickly close with a couple of key takeaways that we really wanted to highlight. So we know that Malaysia has a 12 Malaysian plan that's been where they pledge to be a carbon neutral country by 2050. But 4 important points to highlight. So firstly, the government has endorsed the proposal to develop the DETs with implementation plans for a national carbon tax in the future. But still to this date, there have been no formal carbon tax frameworks announced. And secondly, in alignment with this, right, the government has also planned to increase the RE capacity to 31% by 2025 and 40% by 2035. And they've also developed MGATS, which will be the national marketplace for RECs, in line with these two initiatives. But on points 3 and 4, they're quite closely linked. So in point 3, right, there are no, at least in Malaysia, there are no domestic offsetting schemes that are operational yet in Malaysia. So as Chin and Yulia talked about earlier, Malaysian companies could really considering registering to applicable international standards such as Verra and Gold Standard. And this is where Malaysia can also play a large role in supplying these carbon credits from carbon removal NCS projects to these global or domestic compliance schemes. But again, to be mindful of that, any schemes that involve international carbon trading will be more regulated, as this will impact the country's NDCs. So we just need to keep a close eye on how this will develop, especially in the new Paris Agreement context and new world that we live in. So before I pass on the floor back to SK for the Q&A, just one more quick Mentimeter poll for everybody. If you kindly, sorry, let me shift it. Right. So after today's workshop and the information that we've shared today, what do you think could be your next steps in preparing for the carbon pricing mechanisms here in Malaysia, especially for your company in particular? So any thoughts, ideas are encouraged. Change the government. So ICP, carbon tax. Internal discussion with stakeholders, absolutely. Trading platform, carbon tax. So we've quite a few carbon taxes. Again, tax exchange platform. Market watch. Any other ideas that come to mind immediately after our workshop? How trade carbon products for profit, product offerings that can initiate incentives. Absolutely. Right. I think feel free to continue contributing to the poll. I think if we could pass on to SK to help us close with the Q&A portion of our presentation. Thank you very much.
Yeah. Many thanks, Kevin and Chin, for the Malaysian context and the sharing session on Malaysia. Actually, I must say I'm very grateful for all the participants. We still have over 200 participants on this webinar. For these 2 hours, we have remaining 8 minutes, and there are a lot of questions raised. We address some of them. Now I still have 18 questions. Maybe let me go with this one first. Yeah. I think those questions related to, like, for example, like is whether like carbon tax a burden to the general public, impact on inflation, I think may not be very appropriate for YARAM to address. I think those I probably will leave it to the government to address those questions. We come back focusing on what we can effectively address. And maybe one question here is like, IEC are mainly used to address scope 2, while carbon credit offset can be used to address scope 1, 2, 3 emissions. What are typical pricing difference between the two instruments? Yulia or Chin, you want to address this question, please?
I can start, but Chin, feel free to step in. There are, again, a lot of components that dictate the prices. And by the way, in each market, the prices will be very, very different. But the project's complexity in terms of project like development, registration, certification, as well as competition on the market, they all would impact the prices. I don't remember specifically for Malaysia, I will be honest. Probably Chin would know better what would be the most recent cost comparison of FREX and the carbon credits. But again, you would need to compare apples with apples. What would be the cost of FREC versus the carbon credit from the renewable energy project, right? Because all other project types will be absolutely different in their nature and the way they operate.
Yeah, as of now, like what we have mentioned just now in the presentation, a lot of the companies are able to sell back to the grid and therefore able to fetch a price directly. I think ERM, SK, myself, and the rest of the team members has done a lot of research locally. What will the carbon price for us in Malaysia and in this region? As of now, a lot of green projects, whether it's justifiable to have them for now to start, right? To forecast with certain pricing in order for the project to be able to be implemented or being pilot tested. So this is a key issue here within Malaysia, where internal carbon pricing will come in for a lot of decision for companies, right? Whether you can try out project A or project B, advancing to what the global trend is having right now on carbon pricing and also carbon tax. So I encourage companies to go towards to internal carbon pricing in order to evaluate and for decision-making purpose within your company before we actually advance to the like what we have in EU countries, right? Thank you.
Yeah, Chin, I echo what you say, especially internal carbon pricing, because from my view as well, this is a very important sort of tool for you to actually deploy your resources, right? For example, let's say you invest in a project which have quite high carbon emission. If you ignore the carbon cost to the project, you may think that it's a very attractive project. But a couple of years down the road, let's say, for example, in a Singapore case, right? The carbon tax is currently at $5 per ton. And government already announced by 2030, you'll be raised to 50 to 80 dollar per ton. So you can imagine the cost of the project or the attractiveness of the investment will be very different from now versus going forward. So that's why I think we urge or encourage companies to take a very serious look at the ICP yourself, yeah, to actually how you actually help to deploy resources effectively. All right, I'd like to move to another questions on like, would biomass produce renewable energy project allowed as an EAC? Chin, you want to address the question?
There are a lot of companies and organizations are looking into this, especially in Malaysia, with full of resources, biomass from waste or biomass from plantation, even from the greens. Yeah, we are full of greens. It needs to be done in a way that practical, let's say in terms of technology. And also, I think this is proven elsewhere in other parts of the world. But at this current moment, there are also a lot of issues as well regarding this. For example, whether the mechanism itself, right, the processes itself, we do not want to actually burn and then also at the same time, right, emit CO2 concentration that contributes to the world, right? There are also whether viable to have a consistent and supply of the biomass itself sufficient enough to supply to the system, to the entire ecosystem of this kind of approach. Other than that, there are also market survey mentioned that logistic, to transport it, let's say from a very isolated plantation area to a mill, to a plant, to something very far, a place that very far, where the transportation itself, the process itself will emit more CO2 or not. So all this need to be studied and then be planned wisely before we actually make any decision, taking biomass as one of the resource step for reduction.
Yeah, thanks, Shin. I'm mindful of time, I'd like to address one more question with 3 lights here. For LSS, the large-scale solar project selling to TNB, does the IEC belongs to TNB or are the project free to sell to corporates? TNB has the green tariff, which I believe come from these LSS projects. Are we not double counting them? Chin,
I think at this moment, a lot of large-scale projects are being signed or MOU with TNB. right? This is what we experience. Yeah, in the future, what will be the policy like? What will be the incentive of this selling to other companies rather than to the grid? We will need to see what are the coming measures taken by TNB itself, and also what are the government is setting up in the near future, right?
Okay, thanks, Shin. And I really appreciate all the audience for stay for, we are on the 12 noon dot now. So many thanks to Yulia, Chin, and Kevin for your very interesting presentation. Now I'd like to pass the floor back to CMM to close. Navina?
Thank you very much. And so in closing, let me just say thank you to SK, Chin, Tirapon, Yulia, and Kevin for your time. I think it was an excellent session. I've got a lot of text coming in about how great it was. I know you haven't been able to respond to all the questions, so we will, if you will get the team to respond to the questions, and we will send an email out to everyone on the call today with all of the questions and answers, as well as the links to the recording and the slides. So thank you everyone for joining us, and we hope to see you at our next webinar. Bye everyone.
Thank you very much. Bye-bye.